Investors around the world are holding their breath for a U.S.-China trade deal. Is that enough to shift momentum and make the worst over for the global economy? Joining me is Steve Wieting. He's Global Chief Investment Strategist and Chief Economist at Citi Private Bank. How bad, I mean, has it gotten, we've seen the German manufacturing numbers are awful, et cetera, et cetera. Right. But what is going on with the global economy? Is the worst of it priced in, do you think?
Well, look, we have not had some severe overshoot to the downside in markets that would give us some clear path to extraordinary positive returns. The economy is taking a legitimate hit from tradable goods, from manufacturing, with a slowing investment climate. What's really striking is even in a country like Germany, retail sales are growing 4%. Wow. Industrial production's down 6%. In the US, there's a very big split. China. Underlying consumer demand fundamentals look very solid. Inflation is low. And most of the recession risk we see is man-made. It was either monetary policy mistakes, trade-related issues.
And or everybody talking themselves into a recession, which also happens in these kind of low-growth environments. Let me just
usually there's a bigger problem first. So what we can do, usually see at this point, is if central banks are easing, if we can cushion demand, we can outlast the manufacturing downturn. That's our base case.
So that's hence all the focus on what central banks are doing. So what is your advice for investors in this kind of environment? So
lots of caution we see among investors, those who are just staying out. And we do think that that probably gives us some better returns if we look over 12 months, barring some big policy mistakes. What's most important is that global bond yields, including emerging markets, including high yield debt,
are
fallen to 1.5%.
Yeah, you can't get any yield.
So this has really shifted what you can possibly do with the income portion of portfolios, way down on the fixed income side. So we've gone underweight fixed income from overweight just about a month and a half ago.
And where do you go for income now?
Well, I think this is going to be an equity story. And it's not strictly about let's throw all of your money in equities, but up in quality, current income producing equities. And we're just not talking about bond equivalents. So it's really coming down to dividend income growth. It's being a little more cyclical than, again, buying your utility. But this is how we're going to get current income into portfolios, plus some other techniques we can talk about.
Well, and I can imagine you making that pitch to investors. You want your yield, you're going to get it from stocks. You're going to have to get pushed into there. Steve, thanks very much.